Hey, welcome back with me at Mr. Suw Crypto, the most laid-back hangout spot for those of you who want to learn about crypto but don't want to listen to complicated explanations like macroeconomics classes. Today, I want to talk to you about something that is often overlooked by beginner investors. Even those who have been in the game for a while sometimes still take it lightly. You know what? Yup, exit strategy. Seriously, entering the market is easy. Just open an exchange, buy some coins, and you're done. Exiting the market with a profit? That's the hard part. Because once the profits start rolling in, our brains usually get caught up in the euphoria. Wow, this is keep going up. Let's not sell yet. Maybe it'll go up 10x more. Then, suddenly the market crashes, the profits disappear, and we're left scratching our heads. Let's be honest, you've probably experienced that. Or at least, you've seen your friends go through it, pretending not to be affected while secretly panicking. That's why today we're going to thoroughly discuss how to exit the market. When is the right time? How do you do it? And most importantly, how to avoid becoming a victim of FOMO or regret, like an ex who shows up when you've already moved on. I've prepared 4 exit strategies you can choose based on your own style and risk profile. There's no one-size-fits-all solution, no one-size-fits-all strategy, because what matters is what works for you. But one thing is certain. After listening to this episode, you won't just be an investor who's good at entering the market, but also knows when to exit elegantly. So ready? Grab your coffee, take a deep breath, and let's dive into this episode. Exit strategies in the crypto world. Chapter 1. Exit according to the market cycle, playing smart in the crypto cycle. All right, now we're moving on to the first strategy. Exit according to the market cycle. This is a classic strategy, but don't be fooled. It's actually the strategy that's most often overlooked. Why? Because many people are too busy enjoying the bull run to remember that the crypto market has one very consistent habit. It rises high, then falls deep. Did you know that every time Bitcoin has a halving event, usually around 500 days after that, boom, we hit the market peak? This isn't a myth. It's not neighborhood gossip. It's based on data from previous cycles. 2013, 2017, 2021, all followed the same pattern. After the halving, it rises, then crashes sharply. So, this strategy is like climbing a mountain. You enjoy the view at the top, but don't linger too long taking selfies and forget to come down. Because if you don't start coming down at the right time, you might miss the opportunity and get caught in a storm. So, how do you execute an exit based on the cycle? Here's the simple version. Look at the calendar, mark the halving date, and count forward about 12 to 18 months. When you're nearing that peak, it doesn't mean you have to sell everything, but start trimming. Take some profits, withdraw your capital, prepare cash. You can start by exiting 10% first, then observe the market reaction. If it's still bullish, you can hold on to the rest. But if it starts to move sideways for a long time or shows signs of distribution, don't hesitate to take more. Because in the crypto world, there's no perfect exit, but there's an exit that's prepared, and that's far more important. You don't have to sell everything either. If you believe in your assets, like Bitcoin or Ethereum, you can hold on to some. But still, profits need to be realized, bro. They're just on the screen, not in your pocket. There are so many cases of people who've made 10x profits but didn't sell because they were waiting for the next top. Well, turns out the top had already passed, the market crashed, and now they're stuck in sorrow. And what really gets me is when they say, "It's okay, I'm in it for the long term." Bro, if you've already made 10x and didn't sell, then the market drops 70%. That's not long term. That's hoping for a miracle. Market cycles can be used as a logical framework for decision making. It doesn't mean you have to be a fortune teller, but you can create a game plan. For example, I'll start exiting in small increments when BTC hits $80,000. Trimming again at $100,000. If it enters the euphoria phase, social media indicators are buzzing, influencers suddenly turn bullish, and crypto YouTubers set absurd targets like BTC hitting $1 million. That's when I'll exit more aggressively. Especially if the fear and greed index is above 90. That's a sign we're entering a risky zone. But remember, this isn't about guessing the peak price. Don't try to be the market god. The focus is on securing profits as the market rises. Because ultimately, what keeps us surviving and compounding our wealth is knowing when enough is enough. Lastly, bro, Many people enter crypto for financial freedom, but end up trapped by the market because they lack an exit strategy. Don't be one of them. You have a choice. Do you want to be the one who exits while the light is still green, or the one who realizes it's too late when the alarm is already sounding? Chapter 2. Moonbag Strategy. Safe Capital. Potential for Continued Growth. Alright, now let's discuss a strategy that I think you really need to know, especially if you like to hold on to coins that have already given you profits. It's called the Moonbag Strategy. What is Moonbag? In short, it's a strategy where you sell part of your position when the price has risen significantly, usually double or more, but keep the rest of the coins as a safety net in case the price keeps soaring. Simple yet powerful. And most importantly, your capital is returned and your risk is zero. It's like fishing. You catch a lot of fish, then you keep half to grill and release the other half back into the pond. Who knows? Maybe they'll multiply into a whole new pond full of fish. How does it work? Here's the deal. For example, you buy $1,000 worth of Bitcoin when it's still at $20,000. Then, in 1 to 2 years, the price rises to $40,000. That's a 2x profit. At this point, you can choose to sell 50% of your position. That means you sell $1,000 worth of Bitcoin and your initial capital is returned. The rest? That's your moonbag. You're no longer using capital, but you still have a position. If the price keeps rising, great. You're still in the game. If the price drops, safe. You've already withdrawn your capital. Your mindset is more at ease. This strategy keeps you from getting anxious when the market corrects sharply. Psychologically, we often hold on to losses too strongly, but don't know when to take profits. The moonbag provides a structure for those who want to stay in the uptrend but aren't greedy. Why is this strategy powerful? Because it gives you two things that are rarely available together: profit-taking and optionality. You don't have to worry about missing out on the rally if BTC prices continue to rise to $100,000, $150,000, or even higher. But you also don't have to fear a sudden market crash like in 2022, because you've already exited the arena, but you're still watching from the VIP stands while sipping coffee. Hot beverage. And this isn't just for Bitcoin. You can use this strategy for altcoins too, of course, with careful consideration. Example, you buy a DeFi token during a bear market at 10 cents, and during a bull market, it rises to 50 cents. You take out 50% of your capital and consider the remaining tokens as a moonbag. If the token suddenly experiences FOMO and rises to $2, you still have a position. But if it drops back to 20 cents, well, your capital is safe. Just wait for the next cycle. But what if you don't get to sell when it doubles? No problem. Moonbag isn't about precision, but about the intention to profit through discipline. If it rises 150%, but you're satisfied, take half. The key to this strategy is that you've already recouped your capital. Sometimes prices can rise faster than expected, or even stay sideways for a long time before rising. That's why it's important to have a plan from the start. Don't wait for instinct or feeling, because crypto doesn't play by emotions, bro. You can set alerts, or even if you're trading on an exchange with auto sell or trigger order features, you can set it up automatically. But still, you need to have logic first. Don't just follow the market or YouTubers who say, this coin is going to 100x. The psychological aspect that's just as important. Moonbag also helps you avoid FOMO and panic. Why? Because once you've exited your capital, you're no longer emotionally tied to the chart. If the price goes up, you're happy. If it goes down, you stay calm. If it's sideways, you can sleep soundly. Compare that to those who keep holding on to large positions and never take profits. They check prices every day, their hearts racing, and sometimes even sell at low prices out of panic. If they used the moonbag strategy, they might be in Bali right now, sipping coffee in peace. Practical tips for using the moonbag strategy. 1. Set your exit target before entering. Don't wait until you're making money to think about exiting. 2. Use a 50-50 ratio as a baseline, but you can adjust it according to your preferences and risk profile. 3. Don't be greedy. You don't have to catch the peak. Just take your capital and let the market work for you. 4. Use a simple spreadsheet to track your positions. This is crucial so you don't get confused about which ones are moonbags and which ones aren't. The moonbag strategy isn't just about making money, it's about survival. And in crypto, it's the survivors who win in the end, not the fastest. not the smartest, but those who can manage their emotions and stay disciplined in their strategy. So, if you want to be an investor who stays calm during downturns as well as celebrating during upturns, the Moonbag strategy is your best friend. Chapter 3. Gradual exit at psychological levels. Take profits in installments. Avoid regret. All right, we've all been there, holding on to coins whose prices keep rising, and you think, hold on a bit longer, it might go up even more, but you're also nervous. What if it crashes like last time? Well, for those of you who often find yourselves caught between greed and fear, this gradual exit at psychological level strategy is perfect. Because the principle is simple, take profits in increments at key prices that can be predicted psychologically. What are psychological levels? Here's the thing. In the trading world, there's something called round number bias. This is a condition where many people, both retail and institutional, tend to react more strongly when prices hit round numbers. For example, Bitcoin $100,000, Ethereum $5,000, Solana $200, Matic $1. Why are these numbers important? Because the human brain is comfortable with round numbers. And since everyone has the same tendency, these numbers often become major buy-sell points, i.e., strong support and resistance levels. Therefore, this strategy teaches us to gradually sell when prices hit these numbers, not waiting for an uncertain peak, but having a rational and easy-to-remember structure. Example of implementing this strategy. You buy Bitcoin when the price is $30,000. You have the following gradual selling targets. Sell 20% at $60,000. Sell 30% at $80,000. Sell another 30% at $100,000. The remaining 20% becomes a moon bag or for the next phase. Here, you're not aiming for the peak. You're aiming for the high probability that many people will start taking profits in that area. And when many people take profits, that's when you follow the trend and take your share. This is far more rational than waiting for Bitcoin to reach $250,000 and then losing out when it retraces to $60,000. Advantages of this strategy. Structure and discipline. No drama, no FOMO. You know where to exit partially. Minimal emotion. Since it's already determined from the start, you don't need to think again when the market is volatile. Can use grid exit. You can set it up on exchanges like Binance, Bybit, etc. You can even auto-sell at certain levels. Suitable for investors and traders. Can be applied to long-term portfolios or swing trades. The drawbacks? Yes, this is a good strategy, but there are still drawbacks. You might not hit all exit targets. The market sometimes fails to reach certain psychological levels. For example, if you set an exit at ETH $5,000, but the highest price only reaches $4,900 before crashing, well, you won't get it. If the market is super bullish, you might miss out on maximum gains. For example, if you've already exited at $100,000, but BTC continues to $150,000, well, you can only watch it go. But hey, you still made a profit, and that's what matters most. High discipline required. Don't waver when prices rise slightly and then correct. This strategy requires determination and consistency. The psychology behind this strategy. This is the part that's often overlooked. This strategy gives you healthy closure. Imagine, you've taken profits in stages. So when the market corrects, you don't panic because you've already realized your profits. Compare that to those who wait for the top, but never take profits. When prices drop, they regret it, panic, and sometimes even panic sell below their entry price. That's a loss that shouldn't have happened. This strategy also helps you manage expectations. Sometimes we're too focused on how much can I get, when what's more important is how much can I secure now. How to set up this strategy for beginners. It's easy, bro. 1. Identify your entry point. For example, buy ETH at $2,000. 2. Set incremental targets. For example, your exit targets. $3,000, sell 25%. $4,000, sell 25%. $5,000, sell 25%. The rest is up to you, moon bag, trailing stop, or hold. 3. Use a limit sell order. On major exchanges like Binance, you can set a sell order at your desired price. Just sit back and relax. 4. Track with a spreadsheet. Record all positions to avoid confusion or forgetting. Alternative, hybrid strategy. You can also combine this with a moon bag or trailing stop. Example, sell 30% at $100,000. Another 30% at $120,000. 20% at $150,000. The remaining 20% you set as a trailing stop. So if the market drops sharply, it still sells automatically. This way, you cover all possibilities. Make a profit, have a position if the market keeps rising, and stay safe if the market reverses direction. In essence, gradual exit at psychological levels is a strategy for those who want to stay realistic in a world filled with FOMO. Not everyone can catch the peak, but everyone can plan for profit. Don't let your profit turn into a loss just because you're waiting for the price to rise a little more. If you could have made a 3x profit but didn't take anything, then the market corrected by 60% and you panicked and sold. That's not the market's fault. That's your unclear strategy. If this strategy works for you, don't forget to prepare your exit grid from now on. Don't wait until the market is euphoric to panic and ask, when should I sell? Ready to move on to Chapter 4, Trailing Stop Strategy, which will discuss the most technical strategy that can save you from horror dumps. Chapter 4, Trailing Stop, Protecting Profits, Avoiding Panic. You've made a big profit. Your coin has tripled in value, but you're confused. If I sell now, what if it keeps going up? But if I hold on to it, what if it crashes? This is where trailing stops come in. A trailing stop is a flexible and adaptive exit strategy, but it's also disciplined. This strategy gives you the opportunity to follow profits as the market rises, while also protecting your gains if the price suddenly reverses direction. Let's discuss this in detail. Relax, take it easy. You don't need to be a programmer to understand this. What is a trailing stop? In short, a trailing stop is like your profit's bodyguard. It stays right behind the rising price. But if the price drops to a certain level, cut. Your position is automatically closed. Practical example. You buy Bitcoin at $40,000. Now the price is $60,000. You set a 10% trailing stop, meaning, as long as BTC rises, the stop rises with it. But if BTC suddenly drops more than 10% from its peak, e.g., from $65,000 to $58,500, your position will be automatically sold. So you still make a profit, but you don't get stuck when the price crashes. Why is a trailing stop powerful? Lock in profits when the market rises. You don't have to guess when the peak will be. Protect yourself from sharp corrections. The crypto market is brutal, bro. Sometimes it drops 20% in a day. A trailing stop can be a lifesaver. Suitable for bull markets. When the market keeps rising, a trailing stop helps you ride the wave, but exits if the trend changes. Minimal drama. No need to stare at charts 24/7. The system does the work, not your emotions. How it works in more detail. You need to understand that there are two types of trailing stops. 1. Percentage trailing stop, percent. Example, 10% trailing stop. If the price rises from $1 to $2, the stop moves up from 90 cents to $1.80. But if the price drops from $2 to $1.79, boom, your position exits automatically. 2. Fixed trailing stop, dollar. Example, a $500 trailing stop. If you buy ETH at $2,000 and set a $500 trailing stop, the stop initially sets at $1,500. If ETH rises to $3,000, the stop moves to $2,500. If it drops below $2,500, the position automatically closes. Simple, right? Where can you set a trailing stop? Many major exchanges already offer this feature. Examples include Binance Futures and Spot, Bybit, KuCoin, OKX. If your exchange doesn't support trailing stops, you can use trading bots like 3 Commas or CoinRoll, manual trailing with alerts plus limit orders. The point is, this is no longer a pro trader-only feature. Everyone can use it, as long as they understand how it works. Example of a real strategy using trailing stop. For example, you buy Solana, SOL, at $20 during a bear market. SOL rises to $40, set trailing stop at 15%. Price rises to $60, trailing stop moves to $51. SOL rises to $70, trailing stop moves to $59.50. Suddenly the market corrects to $59, position is automatically sold. You exit at $59. even though the entry was only $20, meaning nearly 200% profit, and no need to cry when SOL drops back to $40. Important tips when using trailing stops. Don't be too tight. A 3% trailing stop in crypto? Unless you're a scalper, that's suicide. Crypto is volatile. Use something reasonable, 10 to 20% for swing trading, 30% for long-term. Don't use small exchanges. Sometimes stop losses fail to trigger. Use exchanges with good liquidity and stable features. Don't adjust during panic. Once you've set a trailing stop, leave it alone. Don't move it because of FOMO or fear of missing out. Understand asset volatility. Coins like Bitcoin can be more stable than small altcoins. Adjust the trailing stop accordingly. When is the best time to use a trailing stop? When the market has risen significantly and euphoria sets in. If the fear and greed index is in the greed or extreme greed zone, a trailing stop is your best friend. After your coin has risen by 2x or more, this is the perfect time to lock in profits. Let your gains stay safe. When you can't monitor the market full-time, you're working, have other projects, creating content, raising chickens, a trailing stop helps you sleep soundly. Strategy combination, exit plus trailing stop equals super safe. You can combine strategies. Sell 50% manually at a psychological level. Set a 20% trailing stop for the remaining 50%. So, for example, if the market keeps rising, you still make a profit. But if the market crashes, the trailing stop will sell the remaining position and protect your capital. Win-win. Challenges of using a trailing stop. Requires learning and testing. Not everyone gets it right away. But once you understand it, you'll be hooked. Sometimes doesn't trigger perfectly. In highly volatile markets, prices may wick and touch the trailing stop, but then immediately rise again. You might get sold too quickly. Can be emotionally frustrating if you're not disciplined. Sometimes you might be tempted to adjust the trailing stop out of fear of missing out. But that defeats the purpose of this strategy. Let the system do the work, not your emotions. A trailing stop is an automatic break that can save your profits from a correction. It's not about being a genius trader. It's about discipline, risk management, and protecting what you've already earned. If the market keeps rising, you rise with it. If the market suddenly crashes, you exit safely. It's a win-win situation. If you've hit a big profit but aren't ready to lose it, a trailing stop is a strategy you can rely on in crypto. Don't be too greedy. Don't be too afraid. Use the system. And most importantly, profits aren't about guessing the highest price. It's about being able to exit at the right time. All right, bro, those are the 4 exit strategy chapters. We've discussed 4 exit strategies that can help you survive and maximize profits in the crypto world. 1. Exit according to market cycles. 2. Moonbag strategy. 3. Gradual exit at psychological levels. 4. Trailing stop strategy. Exit strategies are not about guessing the peak, but about saving your profits. Dear loyal listeners of Mr. Suw Crypto, we have had lengthy discussions about various exit strategies from the crypto market, from those based on major cycles to dynamic strategies such as trailing stops. And if there is one thing you can take away from this episode, it is this. An exit strategy isn't about being a fortune teller. It's about being a trader who knows when to stop. In crypto, too many people are focused on when to enter, but forget to think about how to exit safely. Even if you have the best entry point, the most advanced research, and intuition as sharp as an oracle, if you don't have an exit plan, everything can fall apart in an instant. So, which strategy is right for you? The answer, it depends on your profile. If you're a long-term investor and believe in cycles, exiting based on cycles could be your main strategy. If you like flexibility, a trailing stop is the best guardian for your profits. If you like control and don't want to leave everything to the system, gradual exits or moonbags could be your go-to. And you don't have to choose just one. You can combine them. There's no such thing as a magical exit strategy. What matters is a strategy that fits you and the discipline to follow it. Don't forget, hot money equals your main enemy. No matter how sophisticated the strategy, it won't work if the capital you're using is money you need to pay rent, loans, or household expenses. That's why, before you trade, instill one important principle. If that money is lost 100%, my life won't fall apart. That's cold money. And that's the mental foundation for exiting without panic. Take note, bro. In the crypto market, it's not the smartest who survive. It's the most disciplined and those who know when to stop. If you can have a well-planned entry and a well-planned exit, you're already ahead of 90% of traders out there. And now, it's time to wrap up with Mr. Suw Crypto's sacred reminder. Key 5 important rules of Mr. Suw Crypto. 1. Never use money for important needs for investment. Crypto can be highly profitable, but it can also cause stress if you're reckless. 2. Avoid over-leveraging. Want to get rich quickly? It's possible, but if you don't control it, margin can cause you to lose first. 3. Maintain the composition. 70% Bitcoin for stability, 30% altcoin for opportunities. Mix them all. Go ahead, but be prepared if a storm comes. 4. Always keep a contingency fund. Market crash? Use it to buy discounts. Don't just watch. 5. Play the long game. You're not here to get rich in a week. You're here to survive and grow over the next 5 years. Thank you for listening to this long episode with Mr. Suw Crypto. If you found this episode useful, click the follow or subscribe button, share it with your friends who are still unsure about exit strategies, and write your thoughts in the comments section. Which strategies have you used, and what were the results? Remember, don't just watch the market. Understand it, plan, and execute with discipline. See you in the next episode, where we'll dive deeper into advanced topics, including re-entry strategies, asset rotation during alt season, and how to read market structure like a pro trader. Stay profitable, stay sane. Peace out, and see you in the next Mr. Suw Crypto episode.